Okay. And for those of you that are, so I'm on the first slide right now. For those of you that are wondering about this title here, that is the Blue Book citation for the One Big Beautiful Bill Act. So if you're a tax nerd like me and you want to cite the legislation, that's the actual citation. Just want to quickly put in our disclaimer here. Okay, so the first thing that we want to consider for the One Big Beautiful Bill Act is the tax policy. The tax policy tells us why. So when I do a lot of these webinars or presentations, I'm kind of like a reporter: who, what, where, when, why, how, all that stuff. So we're going to start with the why. And the first thing that everyone has to understand is that the current administration, their big policy is called the America First policy. That drives pretty much everything that is occurring at the federal level from the president on downward. The America First policy is not a new policy. It's not like the Trump administration or the Heritage Foundation came up with that, just recently. This actually goes all the way back to Woodrow Wilson. He campaigned on the slogan. I don't think he created the words America First policy. I think that was actually back in the 1850s, but he campaigned on it, kind of really made it a central part of his platform. It was a reaction to World War I and kind of America drawing inward following what happened in World War I. And today we've got, this is on the right-hand side of the slide here, or if for those of you that are looking at the slides, it's just a snip here of the executive order for the America First policy that President Trump put out on January 20th. I will note that the America First policy, when it was kind of implemented after World War I, the end result, so when America First policy ended, as you can see on the slide that I put on the screen here, the top tax rate in the United States, this is 1944, the top tax rate in the United States was 91%. So the greatest generation, not only fought in World War II, but also paid the highest amount of tax possible that we've ever seen in the US tax code, so 91%. And for those that want to learn more about the tax policy, because there's a high probability, or not a high probability, but a potential probability that there may be another tax bill before the end of the tax year. But for those that want to learn more about where the tax policy is coming from, what's driving it, what's motivating it, you can find that in the Project 2025 publication that was put out. And it'll be in section 4, number 22, the Department of the Treasury. It's all kind of put into that section right there. Okay, so now we're going to move on. We're going to go to kind of how the Beautiful Bill Act was rolled out, the short title, items that were included, and the general impact. And so we've got to start with your point of reference is the 1986 tax code that was amended in 2017. This is a snip of the Tax Cuts and Jobs Act of 2017, just kind of the first page of it. So that's kind of the starting point. And the Tax Cuts and Jobs Act of 2017 was passed in 2017. A lot of the legislation covers the period of 2018 through 2025, and a lot of that legislation was set to sunset or go away at the end of this year, which would have caused real problems. And so the One Big Beautiful Bill Act, and this is a snip of the House bill as it was originally introduced, is kind of the response to make sure that a lot of those items didn't sunset and then add in new items from the America First policy. And so the legislation came out on May 19th, but was officially introduced on May 20th by the House. It was passed in the House on May 22nd. And so what normally happens is once it goes from the House, it then has to go to the United States Senate. The Senate then mulled it over for a very, very long time. They passed their version on July 1st, and it was a race to the finish. There were a lot of people that didn't want to vote for the legislation. There were a lot of promises. Again, one of the reasons why I mentioned there may be another tax bill is because there were a lot of promises that things that didn't get in may come in at a later time. So in order to get the votes, there were a lot of promises that were made to get to your July 1st passage. It then went back to the House because they have to do what's called a conference to make sure that everyone agrees to it, both House and Senate. The Senate agreed to, the House agreed to all the Senate changes on July 3rd, and it was signed into law by the president on July 4th. There are a lot of different acronyms floating around for the One Big Beautiful Bill Act: OBBBA, OBBBB, BBB, OB3. I like OB3. I'm a big Star Wars person. If you ever talk to me, I'll go on about Star Wars or Star Trek. I like both of them. So I'm going to go with OB3, and that's what I'm going to refer to the act as moving forward. Okay. What did not make it into the bill? So things to maybe think about or circle that didn't make it into the bill, but potentially could come into a bill later on in the year. So there's a big push by Americans abroad to try to end worldwide taxation for individuals and convert to residency-based taxation. That was considered for a hot minute in the Senate, but then kind of went, no one pushed it forward. There were a lot of introductions of potentially doubling the foreign earned income exclusion, which for 2025, I believe that's 130,000. That would have made it 260,000 for 2025 and moving forward. That did not occur. Potentially eliminating the U.S. estate tax, that didn't make it in there. Simplified reporting for the FBAR in 8938, I don't think that was even talked about. Extending the mailbox rule to electronic submissions, that was not talked about. Codifying certain tariffs, that was not talked about. The revenge tax, which I'm not going to really go into depth today because it didn't make it in. There were a couple different versions, the House version, the Senate version. That was ultimately withdrawn, and I'll talk about that here a little bit later. There was a lot of chatter about potentially lowering the U.S. C corporation tax rate to 15%, repeal of the IRS funding under the Inflation Reduction Act, exempting wage income for first responders, police, and military. I believe that was a campaign promise that was not put in there. The so-called millionaires tax for those making above 2.5 million, tax on carried interest, and reduction in capital gains tax rates. Those were all kind of kicked around, but none of those were included. One last item that kind of almost slipped in there but didn't make it in. This is a snip from the Senate bill, and it's section 70205, tax treatment of certain international entrepreneurs. There's consider, and see, it didn't make it in. So it's 77205. This is the final version. You can see the difference. 205 did not make it in. What that was referring to was the TrumpCard.gov, also known as the US Gold Card, which is something that the president has talked about a couple different times. Similar to a green card, but what happens is that the individual person makes a gift to the Treasury Department of $5 million, and then they can be a U.S. They can come inbound into the U.S. under the immigration rules. And the thought process there was that there would be what's called a non-domiciliary tax regime for these individuals, meaning they're not subject to worldwide taxation. They're only subject to tax on U.S. source income, and they're not subject to potentially the U.S. Estate tax rules, as gift and estate tax rules. So a very, very interesting tax regime. Again, that was considered in section 7205, but it did not make it into the final version of the bill. If you go to trumpcard.gov, then this is on the right-hand side of the slide that you're looking at. It says the Trump card is coming. Whether that will actually come out later this year or not, I do not know. I did discuss that and a lot of different immigration issues as they intersect with U.S. tax law, with Becky Young recently, who's an immigration attorney, fantastic immigration attorney. So if you want to learn more about areas of the U.S. immigration and tax laws that intersect here in 2025 and hear what Becky has to say about that, I thought this was a very well done podcast, and Becky is very knowledgeable. What things kind of changed? So really didn't change, but kind of changed. One thing to note is that for casualty losses, the way it was is that to get a casualty loss, it had to be a federally declared disaster area. And starting in 2026, you can now, if it's state declared disaster, that will count as a casualty loss. One thing I want to make a comment on, just to zoom back for a second, is that OB3 will have a big impact to what the U.S. individual tax return looks like. It'll look a lot different. The 2025 and 2026 returns, they'll change. But additionally, some of the rules come in 2025, some of the rules come in 2026. So keep in mind, I've kind of highlighted in red here when something starts in 2026 and when something starts in 2025. So some of these things, there may be a delayed effect on when they come into play, and just keep that in mind. Moving expenses used to be what's called an above-the-line deduction, not an itemized deduction. That was temporarily put away with in the Tax Cuts and Jobs Act, so we didn't see that for tax year 2018 through 2024. That is now permanently eliminated, except for there's two groups of people that can still claim moving expenses starting in 2026. That would be the armed forces, anyone that's in the armed forces, or an employee or new appointee of the intelligence community. So if you fall into one of those two categories, you may be able to get that above the line deduction starting in 2026. Okay, what is not changing? Ordinary income tax brackets are still the same. So we still have the 7 brackets that we had, before July 4th. There's some inflation adjustment amounts that occurred though for the lower brackets that I think maybe helps out a little bit for 2025. Capital gains, still the same. Student loan discharge, still the same. Mortgage interest deduction rules, still the same. Although I would have thought they would have done some kind of inflation for mortgage indebtedness, given the state of how much it costs to buy a house these days. I thought they would have maybe increased the threshold, but they didn't. Personal exemptions are completely gone, and the 2% floor. So you will not be getting a deduction for your tax preparation fees, wealth management fees, legal fees. You could have gotten that as an itemized deduction for years of 2017 or years prior. That was done away with in 2018, and now that is permanently gone. Okay, what is the impact? So one thing to note, the cost of the bill is estimated to be about $3.7 trillion. And the reason I bring that up is because and the last time we saw the cost and the impact of a bill that's been this high, tax cuts that were this high, we have to rewind back to the Bush tax cuts of 2001. And as a reminder to everybody listening to this, going into 2001, the handover between Clinton to Bush, we had a budget surplus here in the United States of America. We have not had one since. Okay, we're running at a deficit ever since that point in time. And the Bush tax cuts that were put into play in 2001 are, if you've talked to a lot of economists, that might be one of the reasons why that deficit has kind of continued to move forward. So we're now right back to history repeating itself. We've got another, we've added on to the deficit significantly. As far as the impact of the actual bill on an individual level, for those making less than $58,000 annually, your taxes actually just went up. So under 20,000, you're paying an additional 885 roughly. For between 20,000 to 58,000, about an additional 1,090. And then the tax savings start to kick in over $58,000. And so for people making between these figures on this slide, so if you're making between 105 to call it 200, you're going to see about $2,500 in tax savings. Between 200 to 300, about $4,600 of tax savings. Between 300 to 436,000, close to $7,000 of tax savings. So you do no activity at all, and you're going to get tax savings. And part of it, again, some of it implemented in 2025, so you'll see it on your 2025 tax return that you file in 2026. Some of it in 2026, so when you file that in 2027, you should get the full impact at that point in time, and so forth and so forth. If you make over $1 million, $27,000 of tax savings, and then over 4.8 million, $72,000, and so forth. Okay, now let's talk about the specific individual tax updates. So this is a snip of the final version of the tax bill, and I'm highlighting some of the areas that I'm going to be talking about here. I'm not going to talk about every single part of OB3. There would be just way too much to do that in an hour. So I'm going to just talk about certain sections that I think are applicable to the audience today. So the first thing is the standard deduction. So under TCJA, the standard deduction if you're married filing joint is $30,000, and that was for 2025, where we're at right now. If we look at OB3, it goes up slightly, so it's $31,500. But the big thing here with the standard deduction is in lieu of the campaign promise for no tax on Social Security, they're going to be giving seniors, and senior is any U.S. person that's over the age of 65 that has a U.S. Social Security number will get an additional $6,000 on their standard deduction, and there will be phase outs for the $6,000 additional deduction. The deduction is available for both people that take the standard deduction and itemized filers, which is really interesting. Again, you're going to see differences on page 1 of the 1040 and differences on Schedule A. Estimates prior to OB3, 64% of seniors didn't pay any tax at all. And now with this additional $6,000 deduction, 88% of seniors won't pay any taxes at all. The child tax credit. So this starts for tax year 2025. The non-refundable portion increases from $2,000 per child to $2,200 per child, and it's indexed for inflation starting with 2026. I will note that you have to have a social security number for both the parent, that's the filer, the taxpayer, and the qualifying child to be able to get the child tax credit. Very, very important. There is a phase out threshold. So if you make more than $400,000, the child tax credit starts to phase out. And then the refundable portion, indexed for inflation, $1,700. And then there's a non-refundable credit, which I think has been around for a while, of $500 for a dependent that's not a qualifying child. State and local income tax deduction. This one I'm very happy with. I pay, between state taxes and property taxes, I like this one. I think it should have been higher, but that's just me. So the Tax Cuts and Jobs, prior to the Tax Cuts and Jobs Act, you could take your state and local income tax deductions to the maximum point you wanted. Now, the alternative minimum tax was different back then, so there was still, ways to kind of reduce that. But under TCJA, they capped the SALT deduction at $10,000. So starting with 2025, starting with this tax year, that cap is increased to $40,000, and there's a 1% increase each year until 2029, and then it drops back to $10,000 in tax year 2030. For those that have pass-through entities, so partnerships or S corps, there's what's called the pass-through entity tax, the PTET deduction. That pretty much remains the same, maybe some slight modifications there. And then there's a phase down for modified adjusted gross income for the state and local tax deduction starting at $500,000. So there will have to be some calculations on people. So for example, if you don't get the full 40,000, then it's probably something to do with the phase down. 529 plans. Okay, so again, this one starts in 2026, so it's not this year, but next year. The distribution limit increases from a maximum amount of $10,000 per beneficiary to $20,000 per beneficiary per taxable year. And then they broadened what expenses would qualify or be eligible here. So there's this new category called qualified post-secondary credentialing expenses. That's a mouthful. And so this is a great area. I think if you have kids and they're elementary through, call it MBA, take a close look at what's coming in here. I would wait for the regulations. The IRS, bless their heart, they're going to have a lot of work to do. And we're going to talk about their staffing here at the end of the presentation. But the regulations will help kind of define this a little bit further when they come out. And I think they'll be very helpful for how you're going to game plan for your 529 plans for 2026 moving forward. But this is an area of potential tax planning / education planning that you may want to take a look at for next year. Okay, child and dependent care credits. So this wasn't in the part of the legislation that I highlighted earlier. This is a separate part of the legislation, which you can see in the slides in Chapter 4, Subchapter A. Basically, the maximum credit rate increases from 35% to 50% of qualifying expenses. And then there's phased down limitations based off of adjusted gross income. This does not start, though, until 2026. So it's the same calculations you would use for dependent care credits for 2024. You'll use that same calculation for 2025. But for 2026, you may get more of the qualifying expenses coming in. Charitable contributions are pretty much roughly the same, but if you itemize, there is now a 5% floor on charitable contributions. So we use this example of a taxpayer A has $1 million contribution base. They make a charitable contribution of $100,000. That charitable contribution, before you even get to the 60% limitation, could be reduced down to $95,000. Okay. The 60% limitation is now permanent, so that's not going to change. And then there's also this new above the line deduction for charitable contributions for people that don't itemize. It's $2,000 for married filing joint, $1,000 for single. Also, if you itemized in 1 year and you have carryover charitable contributions that go into the next year, but then you take the standard deduction, you can't use those carryovers as part of your standard deduction. You actually still have to make charitable contributions to get the above the line deduction. Okay, what are some of the new things that came in? So I showed this slide earlier. This is the final version of everything that's new for individuals. No tax on tips, no tax on overtime, car loan interest deduction, and the Trump account. So let's go through them one by one. The first one is the deduction for tip income. So this deduction, you can now find this in Internal Revenue Code 224. It's limited though, meaning that it sunsets. It applies for tax years 2025 through 2028, but it goes away in 2029. And there's a limit of $25,000. So that's the amount that can be deducted. And it has to be what are called reported tips. So the tips have to be notated or documented on an information statement that's supplied under one of the Internal Revenue Codes 6041, 6050, 6051. And then you have to have a social security number to get the deduction. There are phase down amounts. So if you're single and your income exceeds 150,000, then the deduction starts to phase down. The deduction is also available for non-itemizers. So if you don't itemize your deductions, you take the standard deduction, then we have a new entry in Internal Revenue Code 63. So it's Internal Revenue Code 63B5, which allows for an above the line deduction for the tip income. I will note that 90 days from the date the tax law was signed, so theoretically October 4th, there will be, IRS is set to produce a list of occupations for tip income so that people can't game the system and say, oh, I'm receiving tip income, it's deductible, when it's really not. Tip income with an occupation that is normally customary and regularly receives tips. So they're going to look at industries that in 2024 that normally receive tip income, and that's what will be going into the list that will come out. Okay, there's a new deduction for overtime pay, and I was mentioning to the HR ops people at the Wolf Group, I said, this is something that I'm sure will be a little interesting for reporting for 2025 for overtime for any employees that work overtime. This one also very similar to tip income. It's got a sunset, so it's applicable for 2025 through 2028, and then it sunsets. And it's limited to $25,000, but that's only if you're married filing joint. If you're single or married filing separate, it's $12,500. So you have to file a joint return to get the $25,000 deduction. So tax planning tip or pointer for people considering filing separately, and say one spouse has the overtime income, the other one doesn't, it may be more beneficial for you to file jointly than it is separately. Social security number is required. This is now in Internal Revenue Code 225. There are phase downs, and if you don't itemize, you can take it as an above the line deduction. So we have a new entry in Internal Revenue Code 63 for the above the line deduction on this one. So dealer's choice. And again, they're going to define what overtime compensation is. It's going to be compensation that is paid to an individual that's under the Fair Labor Standards Act of 1938. So again, that's where people will get their guidance on what qualifies as overtime pay and what does not. Okay, car loan interest deduction, which is now Internal Revenue Code 163H4. Again, this one also has a limited time run, 2025 through 2028. I will note that the final assembly of the qualified passenger vehicle must be inside the United States. There are definitions that the bill kind of works through to determine what final assembly means. So before you go run out and buy a car and think you're going to get the deduction, one big thing you got to check with the auto dealer, is final assembly. And again, really, do you trust the auto dealer to tell you the correct information on the final assembly? Maybe they'll have some kind of document that confirms that, but just make sure that you confirm it's the final assembly is in the United States. Auto loan dealers, interestingly, now they've got to do information filing under Internal Revenue Code 6050 Cap AA. So they're going to have to probably give out some kind of 1099 statement showing the amount that can be deducted. And again, it'll probably state that it is a qualified passenger vehicle with final assembly inside the United States. I'm assuming that will have to be confirmed on their end. But again, just be real careful about going out right now and buying a car while this is still kind of in the works. The deduction is limited to $10,000, and there is a phase down based off of income that exceeds $200,000 for married filing joint. This is an itemized deduction, but if for some reason you don't itemize, again, you can take you can take it as an above the line deduction with your standard deduction. And so we've got now Internal Revenue Code 663B7 that allows that. They did put in a couple provisions to make sure that people didn't gain this deduction. So I guess I didn't know this, but you can refinance your auto loan deduction. And so if you do refinance and you take more indebtedness, which I don't even know how that's possible, but if you did refinance your auto loan into a higher amount, you cannot take the additional interest on the amount above the original debt that you took out. You also can't transfer your indebtedness to someone else, and then they would say, "Oh, I can take that deduction." That's not how it works either. So there are some guardrails against that from occurring. There is the Trump account, which under the House bill was originally called a MAGA account. The Senate changed it to a Trump account. And basically, this is the equivalent of a children's IRA. So if you read the legislation, it says this will be treated very similar to an IRA under Internal Revenue Code 408 little a. There's a $5,000 contribution limit that is indexed for inflation. It is non-deductible, so just because you put the money in there, don't expect a deduction. But you can put it in there. It's not taxable, and basically, it's meant for a child. Your employer can also contribute $2,500 to this plan on your behalf. That $2,500 amount is not taxable income to the employee. I believe it is, though, a deduction to the employer. And no contribution will be accepted until 1 year from now. So these things, I highly doubt you'll even get the option to go to your bank and set this up until probably, sometime in Q2 of next year. But the earliest that you can make a contribution to this would be July 5th, 2026. Now, my assumption is that you could probably put $10,000 into it. They probably allow you to do $5,000 for 2025 and $5,000 for 2026, but we'll see how that plays out. There can be no distributions taken by the beneficiary, which is the child that it's created for, until they turn the age of 18. And then the federal government will provide a one-time credit of $1,000. So they'll deposit $1,000 into or I guess you get a credit on your tax return. That will be done, but it's got to be for a child that is born between December 31st of last year and January 1st of 2029. That child must also be a United States citizen. Okay, I had a lot of people reach out to me on the wagering or gambling loss deductions. There were a lot of people were complaining. It was probably the one thing that almost immediately, and I missed it. I didn't see this when I read the bill initially. Somehow I completely just did not look at this, but all the finance bros, gambling bros, there was a lot of hubbub coming out about it. A lot of people asking me about it. So I kind of looked into it. I'd not really explored the gambling rules in any extent previously, but a little bit of history here. Prior to TCJA, basically, if you were an amateur gambler, you could deduct all of your losses to the extent of your gains. This was called basketing. This was not applicable to professional gamblers. And basically, the way it works is that the gambling income is other income, and then your losses go as itemized deductions. When the Tax Cuts and Jobs Act came out, it said that we're going to align professionals with amateurs, and that was the big kind of change there. The House bill would have made that particular treatment under TCJA permanent, but the Senate decided to change the treatment. And so what has happened now is that you're only allowed to take 90% of your gambling losses as an itemized deduction, meaning that there's a 10% differential between your gains and your losses, and that's starting on January 1st, 2026. So if you're excited about putting some bets on, college football coming up or the NFL season, whatever it is for the rest of 2025, this will not apply. But you go into next year, 2026, maybe the college football playoff or Super Bowl or whatever it is, then you'll have to think about this. Or if you're gambling in a casino in the U.S., this will come into play. But here's an example. So you have someone that was gambling $10,000. They lost $10,000 and they won $10,000. So under TCJA, the result would have been their gambling losses and what they spent is zeroed out. So no tax would have been due. Under OB3, there is an imputed amount of tax of 100 or imputed amount of income on imputed amount of tax on $1,000 of income, which is taxed at ordinary income rates. And then one thing to highlight here, when we want to talk about session netting, and I kind of highlighted taxable year because that was 90% of the losses for the taxable year. So we're interested to see how the regulations will define session netting, because under TCJA, there's kind of an arbitrary cutoff at midnight to do your session netting, meaning you're netting the gambling winnings and losses for that day. That's how that works. But for OB3, it appears now you just net everything together into one big chunk for the entire taxable year. And so that actually makes the netting a lot easier to kind of conform to. I did do a podcast on this, a little mini podcast, or mini cast or whatever you want to call it. So if you want to check that out, that's on YouTube, Spotify, Apple. It's a mini one, so it's only 8 minutes long. Basically goes over everything I just talked about. All right, moving on. U.S. gift and estate. So there's a lot of chatter. The Senate Majority Leader John Thune has been trying for years to repeal the U.S. estate tax. I guess he's a big fan of the Yellowstone TV show, and trying to get that to just kind of go to the wayside. So if we look at where we were prior to OB3 under the Tax Cuts and Jobs Act, the gift and estate tax exemption was 13,990 million. And that was set to sunset at the end of this year, so it would go away. Then we'd revert back to 5 million adjusted for inflation, whatever that number is. Under OB3, they make it permanent, so it won't sunset, which I'm sure makes a lot of estate planners very happy. And it's $15 million for a single individual, 30 million. Obviously, if you have a married couple, you now command a $30 million exemption, and that's indexed for inflation moving forward. Business tax updates. So there are a whole host of things, and my main comment here, and it's not a new kind of comment, but I think it's more relevant now than ever before, is your choice of business entity is super, super important. There are a lot of really amazing things that they did here for businesses, or helpful things. I don't know if you want to call them amazing. Some people may not like them, but if you have a C Corp, an S Corp partnership, there's a lot of things in here where you can save a lot of tax. But the setup of your company is very, very important. And one example of that is the qualified small business stock rules. If you don't kind of get that right from go, you may miss out on a lot of tax savings. But I will tell you that it's really, really important to get that planning. I call it the alpha, the omega planning. The alpha is at the very beginning, a lot of times done by our fellow comrades that are attorneys. Let them do the planning. And then firms like the Wolf Group, we can do the omega, where the end of the chain, we do the reporting. But really, really important here. And this is where some of those rules come from. I'm not going to talk about all of them. I just did a podcast with a fellow colleague, Austin Carlson, where we went into a couple of these different topics in minutia. But I'll highlight some of the things I think are relevant to this audience. So the first thing is that we've got a brand new Internal Revenue Code 174 capital A, and this is for startup expenditures, research and development startup expenditures, and it now allows an immediate deduction as long as your startup expenditures for research and development are domestic related. You can elect to capitalize and amortize those over no less than 60 months. So that gives you kind of a 5-year window to take that immediate deduction. But it's an election. It's an election that you have to make. It starts in 2025. So on your 2025 tax return, you would make that election on the timely filed return. So it's got to be a timely filed return. And it would apply to all subsequent years from that point forward. So it's not something that you have to keep electing to do. Bonus depreciation. So on the right-hand side of the slide that I'm looking at is the Tax Cuts and Jobs Act. For bonus depreciation, it was 100% in 2022, and then every single year it's dropped a certain percentage, right? So 80% in 2023, 60% in 2024, 40% for 2025, 20% for 2026, and then 0% for 2027 and beyond. Well, OB3 has now come in and changed that. It is 100%, and there is no table of dropping. It's permanent. It's effective as of January 19th, 2025. So if you bought an asset that's depreciable for bonus depreciation prior to January 19th, 2025, you're stuck under TCJA, so you only get the 40% if you bought it. On or after January 19th, 2025, then you get the new OB3 tax rules. And then as far as the expensing provision limit, it's Internal Revenue Code 179B2. It was 2.5 million. It now increases to 4 million, and that will be indexed for inflation. The qualified business income deduction. So this came in as a response to the C corporate rate, which used to be at graduated rates up to 35%, and then under the Tax Cuts and Jobs Act was set to a flat rate of 21%. So correspondingly for S corps, partnerships, and sole proprietors, they had to do something to make it to where everyone didn't just run out and get a C corp. The answer to that was the qualified business income deduction. So that was actually set to end here at the end of 2025. The House bill wanted to increase the deduction amount to 23%. The Senate decided that they couldn't do that. There was too much tax savings. They needed to raise revenue or keep revenue flat. And so they worked it back down. The final version, it's still at 20%, so it really hasn't changed all that much. There's a minimum deduction for active QBI. I think that's like $400. And then there's inflation adjustments that's permanent, and a lot of these mini changes start in 2026. Okay, small business stock. This is the section in which this comes out of. There's a massive expansion on this one. And if you look at the right-hand side of the slide, the holding period table, I believe, is roughly the same. So if you hold qualified small business stock for 3 years, you can exclude 50% of the gain when you sell the stock. 4 years, 75%, 5 years, 100%. We work with a lot of clients that have these types of transactions. Most of the time, what happens is that attorneys have to prepare a memo indicating how the stock qualifies under 1202, detailing that they met all the different tests. So you have this gross asset limitation test, which basically now that the gross assets have increased, so they cannot. Previously, your gross assets could not be more than 50 million. Now they cannot exceed 75 million. But the great thing here that's happened is the exclusion amount has increased from 10 million to 15 million. So if you sell qualified small business stock up to 15 million and you do qualify, you've held it for 5 more years, you can exclude the full 15 million from tax. So big change there. And again, if you want to get into those rules, and I've said it before, I'll say it again, your choice of entity is very, very, very important. Okay. The other big thing here is the opportunity zones. So qualified opportunity zones were set to sunset here in 2025, I believe. They're now permanent, and they're on a 10-year rolling basis. So they just keep rolling every 10 years, from whenever you start it. Then the rules apply from that year moving forward. If you put your capital gain, whatever your capital gain is, could be foreign, could be domestic, capital gain into a qualified opportunity zone, and you hold it for 10 years, then that gain is reduced by 10%. But you'll be taxed on it, but it's reduced by 10%. If you hold the investment for 10 years, then the capital gain from the qualified opportunity zone investment, if there is any, would be taxed at 0. And then there's this brand new qualified rural opportunity fund, which increases the reduction of the capital gain. So you still got to hold it for 5 years, but instead of getting that capital gain reduced by 10%, you get it reduced by 30%. There's lower investment thresholds for substantial improvement. And one thing to note is that it really must be in a rural area, meaning that your qualified opportunity zone has to be in an area with a town or city of less than 50,000 inhabitants. So really aiming to improve rural areas under these new qualified opportunity zones. And if you want to learn more about that, there are certain experts that can help out and walk you through that. Energy credits. When I look at this kind of rundown of Chapter 5, Subchapter A, the first thing that flashes in my head is Arnold Schwarzenegger in the Terminator movies. So all the energy credits are terminated all the way on down the line. And you can, I'm not going to talk about all of these, but if you want to learn more about the ones that are being terminated and kind of what's going on there, you can look at that yourself. But what I would tell a lot of people is, if you're going to do home improvement credits, so energy efficient home improvement, residential clean energy home improvement, make your updates before December 31st, 2025. You either have to, for the energy efficient home improvement credits, you have to put the property in place before the end of the calendar year. And for the residential clean energy credits, you have to make your expenditures complete by the end of the calendar year. If you don't, you will not get a credit. 2025 will be the last year that we will see Form 5695. It will likely not exist, at least for the near future, in relation to these credits. Okay. For clean vehicles, so previously owned clean vehicles and new clean vehicles, you have until September 30th to purchase the vehicle. If you do not purchase the vehicle and meet all the rules to qualify for the credits by September 30th, you will not get those credits. Okay, those are gone after September 30th. After the OB3 was passed and put into law, so on July 7th, there was an executive order related to these credits as well. So there's a lot of movement in this area, both at the tax level and at the executive branch level. So keep an eye on those if you're in the energy credit sector, if you have a business in that sector, or you're trying to get credits before these things kind of expire or are terminated. Okay, next area is international tax. There was not much in here that is really, I mean, this is the kind of the rundown of everything that came through. I'm not going to talk about a whole lot because there was not much that changed as compared to the Tax Cuts and Jobs Act, which changed a lot for international tax. But a couple things to know. So for those people that have controlled foreign corporations, I guess the Congress finally got the message. No one likes to be called guilty. So guilty is no longer a thing as of the end of 2025. So you'll still have to deal with guilty if you have a controlled foreign corporation potentially on your 2025 tax return. But as of January 1st, 2026, we now have a new nifty name called NCTI, not to be confused with NCIS or any of those cool TV shows. But instead of having guilty income, you'll have NCTI income. And the reason why the revenge tax, which I referenced earlier, that was Internal Revenue Code 899, kind of went away, is because they set the NCTI effective tax rate to between 12.6 to 14%, which was just good enough for OECD to say, hey, look, Pillar 2 won't apply to the United States. So if Pillar 2 doesn't apply to the United States, then I guess that was good enough for the House and Senate to say we won't do 899, even though you still have things like digital taxes floating around out there and other things that we don't like. But 899 was put out there. It is something that could come into a tax bill later on in the year. So that may not be the end of the revenge tax. It may come back into play sometime in the near future. But guilty is now gone. Okay, downward attribution. So for those of you that maybe forgot or didn't know or just didn't remember, Congress made an error when they were writing the Tax Cuts and Jobs Act. It came through so quickly in 2017 that they made a mistake. And they allowed what's called downward attribution for constructive ownership. That's what kind of came out of the Tax Cuts and Jobs Act. It was an error. It was supposed to be fixed in what's called a technical corrections bill, which never happened. For some reason, Congress is very averse to doing technical correction bills since 2017. I don't know why. That normally is something that does happen every time tax legislation is passed. They don't always get it right? No one's 100% perfect. But technical corrections bills are ways to fix things that you got wrong, and they didn't do it. So they fixed it. Like Fix It Felix, they fixed it. And so that starts as of January 1, 2026. There is no more downward attribution. Good news. Bad news, though, we now have a brand new Internal Revenue Code 951B, and we now have this new concept of a foreign-controlled foreign corporation, FCFC. That's a mouthful. So once again, we just have, when it comes to the space of foreign corporations, the rules have once again changed. It's this moving target that keeps on moving. And now, this will be the first time in history where you could potentially have a client issue if that issue started before 2017 and goes after 2026. You could have to look at 3 different sets of laws to really understand and give guidance. You'd have your pre-TCJA rules, then you'd have your transition tax post-TCJA rules under GILTI, and now you've got potentially, NCTI and FCFC rules coming in here in 2026. So my tip of the cap to anyone that practices in this area, because you're going to have to keep a lot of things straight, and it's not going to be an easy thing to kind of relate to taxpayers and clients on how they need to deal with it. The pro rata share rules for Subpart F and NCTI income have also changed, meaning that if you are, a prime example, if you're a partner in a partnership you may not have to worry too much about your guilty inclusion amounts if you had a small amount of ownership interest in the CFC. But starting on January 1st, 2026, any amount is now reportable. So it's going to make the K3s and the amounts that pull through on the K3 as related to the NCTI income super, super important as it relates to your 1040 Schedule K3. So that's going to be a little bit of a change that individual tax preparers and taxpayers are going to have to keep a close eye on. Okay, the U.S. exit tax. There was nothing in OB3 that changed the U.S. exit tax, but since we're here, we're talking about what's new as of July 15th, 2025. I do want to bring into attention for everybody that there was a memo issued by the Department of Justice. It was issued on June 11th, 2025. And what it talks about is it's prioritizing investigations to basically denaturalize U.S. citizens, meaning taking citizenship away from U.S. citizens, and to a lesser extent, stripping people of their green cards. And so they came up with a list of 10 topics that are non-exhaustive, that if they find someone falls into one of these items on the list, you could potentially have a proceeding brought against you to take away your citizenship or your green card. And then number 10 is basically this one size fits all category where, there's no real specific item, but most of these are going to be dangerous to national security. If you've engaged in torture or war crimes, if you are, a part of a criminal enterprise, if you've committed a felony but didn't disclose that during your naturalization process or your green card process, if you've committed a sex offense or you've committed financial fraud, like you did something wrong during the Paycheck Protection Program, if you've committed fraud against an individual or a corporation, you required your citizenship through material misrepresentation, or any other case that the U.S. Attorney's Office that could bring a criminal charge. Those are all things that could trigger the proceedings to remove U.S. citizenship. If citizenship is removed in a proceeding, it will also trigger the U.S. exit tax. That's clearly in Internal Revenue Code 877 Cap A. If you look here in the section for relinquishment of citizenship, capital 4D, if it happens, then not only are you without a country, so you could be countryless if you don't have another citizenship, you would also be subject to the U.S. exit tax. If you are a green card holder and they pull your green card in a proceeding like this, and you've held the green card for longer than 8 years, same thing could occur. So be very, 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 very careful in this space. It is something that is very ongoing. There is a potential argument for at least the citizens that if they pull your citizenship because you never should have had it, that potentially the exit tax wouldn't apply. That's this very, very old Supreme Court case from 1912. But the theory is if you've enjoyed the benefits of citizenship, then you should have to pay the exit tax. So I'm not sure, that's kind of a big question mark right there, but just want to bring that up. On top of the U.S. exit tax, there is the Section 2801 tax, which the regulations were finalized. I believe that was January 14th. So there's the exit tax, and then there's the 2801 tax. So there's two different types of taxes that could apply if the citizenship or the green card are taken away. So be aware of that. This is a snip from a blog post I wrote about it. It's on the Wolf Group website if you want to learn more about the Section 2801 tax. Okay, we had a question about the remittance tax, and I'm going to talk about that briefly next. Okay, so the remittance transfer tax, so just so that everyone understands, a remittance transfer is when money goes from someone inside the United States to someone outside the United States. And the United States is the #1 country for remittance transfers. So on the left-hand side of the slide, you can see the list in they tracked, the last time they tracked this was 2022, and we had $79 billion that was transferred from inside the United States to outside the United States. Saudi Arabia is a close second at 39 billion, Switzerland third at 32 billion, Germany 25 billion. The top countries receiving those remittance transfers, #1 was India at 111 billion. 28% of that comes from the United States, and you had Mexico receiving 61 billion, China 51 billion, Philippines 38 billion, France 31 billion. So this is not a novel concept. It's remittance transfers, and the remittance transfer tax are a lot of countries that have this. It's not like the United States invented this terminology or this tax. It is something that has been thought about. There's actually a World Bank publication on why this is a bad tax that is floating around out there, which I thought was very well written. And I advise anyone that's interested to learn more to read that publication. But there's a new subchapter C in Chapter 36, a new Section 4475 that's effective on January 1st, 2026. So let's talk about how this came out, because it rankled a lot of people when it came out. So when it came out, the initial tax was 5%, and that was on May 12th, 2025. That's the House proposal. The House proposed the tax was 5%. The manager's amendment, right before they passed it, dropped that 5% to 3.5%. That was on May 21st, 2025. And there was secondary liability for financial institutions. And the only exception under the House bill was that you wouldn't have to pay the tax if you were a US citizen or a US national. And when you think about what's a US national, think about someone living in America's Samoa. So once it passed the House, it went to the Senate, and on June 10th, you had Eric Schmidt from Missouri say, no, 3.5% is not high enough. It needs to be 15%. And they interviewed Eric, and Eric said, look, there's billions of dollars leaving our country. It's hurting our economy. We don't like remittance transfers. And it's a major driver of, I guess there's a mass migration crisis. So that's why it needs to be 15%. Well, apparently that fell on deaf ears within the Senate, because the final version was not anything like that. You can find this under Chapter 6 of the final version. It's still Internal Revenue Code 4475. It's 1%. That's the excise tax, meaning that you can't use a tax treaty to get around it. And financial institutions still have a secondary liability, but the tax is limited to cash and financial instruments only. That's the only thing it applies to. So it could apply to a US citizen, but it would only apply to a US citizen that's remitting cash or similar types of instruments. Well, what the heck does that mean? What is cash, similar type instruments? So, for example, I take a bunch of cash and I go to a bank and say, look, I want to take this cash and I want to put it into a wire and wire it outside the United States, or I've got a money order or a cashier's check, and I want to move those funds across borders, then the remittance tax would apply in that particular situation. Okay, so that's what it's pointing at. I'm sure there's a lot of questions about that. I don't really have all the answers to it. There will be regulations that will come out on that, but that's kind of what this is looking at. There is a non-application rule, so it's 4475 little d, and says as long as the transfer comes from a bank under Title 31 or from a debit or credit card issued in the United States, then the tax won't apply. Okay. And so the next question everyone has is, well, what's a bank under Title 31? Well, if you look at this slide here, it's the Title 31, just so everyone understands, is the Bank Secrecy Act. That's the Financial Crimes Enforcement Network. So that's any insured bank, commercial bank, private bank, branch of a foreign bank inside the United States, credit union, thrift institution, broker-dealer, subject to that is registered with the SEC, or broker-dealer in securities or commodities. So, long story short, and I did another mini podcast on this one as well. Long story short, the remittance tax probably has very little impact on most people. It is targeted to a very, very small subset of people that deal in cash or cash equivalents and try to transfer those amounts offshore. Okay, IRS staffing, and then I will answer some questions. So where are we at with IRS staffing, just to kind of give everyone a little bit of an update here. So the IRS has lost over 26,000 employees, and the agency is now down to 75,000 employees from where it started at the beginning of the year. It is a potential possibility that this number, they could lose another 25 to 26,000 employees. So that could be down to 50,000 or less by the end of the calendar year. This is a chart that was released that shows where all the employees were either terminated from or retired from or took early retirement from. And I've highlighted the areas that I think impact this audience the most. So SBSE, they lost about 35% of their employers. The Taxpayer Advocate, they lost a quarter of their employees. Taxpayer Services lost about a fifth. Online services. So good luck, trying to make sure that your online account is giving you the right information. Lost over half their employees. So that's where you'll feel a lot of the big impacts. But this chart will be updated as more and more employees are kind of terminated or let go from the service. All right, and that is it for the presentation. I'm going to answer some of the questions here, and we'll go from there. So the first question is related to the remittance tax and talking about, does it extend to cash? Yes, it's any cash sum. Again, this is generally withheld by the person that's transferring the cash. So it's different if you take the cash on a plane. I think that's a customs rule that you got to be careful with. But we're talking about actually remitting the cash through some kind of medium. Okay, next question. Will there be a seminar for retirees of international organizations? Yes, I'm going to do, I'll be at the World Bank Pension Expo in September, where I'm going to be talking about a lot of this stuff. And I'll be there live and in person, where I will go through that. Would it be possible to focus on implications for G4 visa holders? Yes, it will, but that will be at later presentations. Okay. Some of the residential energy credits could previously be rolled forward if you did not have sufficient tax liabilities in the year you made them. Will that still be possible for solar installations completed in 2025? Well, that's a good question. I don't know. I think yes, it would continue to roll forward because that's under old law. You kind of took advantage of that. I think this is talking about anything that happens after that date. So my answer to that would be likely yes, the rollover would continue as long as you need to use up your credits, but you wouldn't be able to get any new credits after those cutoff dates. Okay, for non-US citizens, taxation rules on life insurance proceeds, taxation of the World Bank pension or foreign pension paid into US bank before being transferred overseas, and any taxation on interest earned on US bank accounts. And there's not really a question there, but I guess that's related to the remittance transfer tax. And again, as long as you're transferring those funds through a bank under Title 31, that should be totally fine. Any news on FERPTA? Any expected impact on the DOGE application to the IRS and the speed of tax returns? Any change in regulations that might affect retroactively? Okay, so let's take these one by one. No changes to FERPTA, and unfortunately, no relief to FERPTA processing because they're firing people or making people retire. They're not adding on a workforce. So the only way to make FERPTA applications go faster is to add people. So my opinion, FERPTA applications processing time will increase, not decrease. The impact of DOGE on the application to the speed of returns. Unfortunately, DOGE has had no effect on that. In fact, there was an article published, I believe, 2 days ago, talking about how the speed of tax returns under emergency proceedings is still 4 to 5 months. So that means that like a congressperson has gotten involved and they've kind of pushed that ball forward, and it's still taking forever to get that done. Any changes in regulations that might affect retroactively? No changes there that I'm aware of, but certainly there could be more changes there. I'm going to skip this one. I will come back to the charitable contributions at a later date. Is there a combined limit on the total deduction for the SALT and mortgage deduction? Well, both of those have limitations on the amount that you can get. SALT has a limitation depending on your income, whereas the mortgage interest deduction is based on the amount of indebtedness that you have. So you have to work both of those limitation amounts separately to determine what those final numbers are that then port over into your itemized deductions. And there are worksheets on when you get your client copy of your tax return, there are worksheets that show you how those numbers were come up with. So a lot of times people will ask me, why is that number less than what I actually paid? And they don't look at the worksheets. You got to look at the worksheet. And if you have questions about how the worksheet works, talk to your tax preparer. When you talk about the additional cost savings of OB3 for individuals at different income levels, is that cost savings relative to tax under TCJA or relative to what tax rates would have been if TCJA had expired? Ooh, that's a fantastic question. I believe it's relative to TCJA, not to what would have happened had TCJA expired. And that is it for today. Thank you so much for joining me. I've hit my exact time limit, 1 hour. And it was a pleasure having everyone. I hope you learned something from today's presentation.